Hello, everybody. We'll get started in just a few minutes. Let everyone get logged in and settled in. It looks like we have about 100 attendees. And this webinar is really geared for people who have some sort of an accounting background. So CFOs, CEOs, controllers, bookkeepers, be a good audience. Going through rehearsal yesterday, it seems like it's a little bit technical, lots of talk about debits and credits. So Peter and I look forward to spending the next hour with you. I just want to give it a few more minutes, let the last people get logged in. Peter, what time do you have?
2 minutes till.
Yeah, so let's wait 2-3 minutes. We're enjoying beautiful October weather here in Colorado. It's actually too beautiful because we have forest fires, unfortunately. It's been very dry. Peter, how's things in Louisiana? You got another storm bearing down on you?
Yeah, it's quite the opposite. It's been very rainy. It's nice today, but we're definitely keeping our eye on the storm in the Gulf to see how that goes.
Yeah, we could use some of your rain.
Love to give it to you.
Well, I think we can start with the introductions. So this is Jim Marty. I am the founder and CEO of Bridge West CPAs, and we are 100% devoted to the cannabis industry. We have about 400 license holders nationwide, and this started basically 11 years ago when I made the decision. I didn't realize what a big decision it would be to sign the tax returns for the fledgling cannabis industry here in Colorado. And it's grown exponentially ever since. In 2017, I merged with our current parent company, Beckerman, Grafstrom, and Mayer up in Minnesota, Minneapolis, and St. Paul. And been a very successful merger. It's enabled us to expand our services nationwide and even internationally, as we have some Canadian clients. We have clients all the way from Hawaii to Maine and from Alaska down to Florida. I have Peter Prevot with us. He is one of our associates out of Louisiana. He holds down the southern part of the United States. Peter's done some great work in Arkansas and Louisiana and Florida. And Peter, tell us a little bit about how you got involved in the cannabis industry.
Yeah, so I actually first met Jim in 2014 when he was presenting at an NCIA meeting. And at that time, I was really interested in the industry and kind of kicking the tires myself through my own practice, trying to figure out how to get involved. And, you know, kind of kept in touch with Jim, and now I've been with the firm for 2 years, and you know, definitely had a breadth of experiences from small companies to large companies, and definitely super excited to be with Bridge West and to be a part of the work that we're doing.
And Peter's being modest. He's been very instrumental in advancing the medical marijuana program in Louisiana. Can you tell us a little bit about that, Peter?
Yeah, so our system here in Louisiana is pretty unique because our supply chain is concentrated to the growing and production being at our agricultural colleges. So LSU and Southern University both have the production licenses. And so I guess that's really where I got very involved in the process here. We had done some work at the Capitol trying to, you know, help educate the lawmakers here. And throughout that process, I met some folks from a company out of New York, one of the original 5 license holders there, represented that company throughout the procurement process whenever these university production contracts were getting issued, and definitely just, you know, learned a lot about the regulations in the industry by going through that exercise. And then from there, I did applications for several of the pharmacies that are in Louisiana. We have 9 spread throughout the state. And currently today, I still work with that group through another organization called Louisiana Association for Therapeutic Alternatives. And our main work at LATA is through the pharmacy board and just working with the regulators to kind of help grow this program here in Louisiana.
Well, very good. And yeah, and Peter helps us with some of the tax returns from around the country as well. So at the end, we're going to have 10 minutes or so with Calvin Shannon. He's a principal with our parent company, Beckerman, Grafstrom, and Mayer. And he will be giving us an update on a new twist to cannabis accounting, IRS Code Section 471C, which came into play at the very end of 2018. So we are experimenting with that code section on 2019 tax returns, and he will tell us about that. We're ready, I think, to get started here. Next slide, please. There we go. Some housekeeping. Yeah, please type up your questions, and we'll go through them at the end of the presentation. We'll try to leave a few minutes, and if we run over a few minutes, it's not a big deal here. And this will be available on our website as well. Thank you for attending. Okay, so it's fall, and it's a great time to get your books in order. I could give this presentation. I have given this presentation to companies outside of cannabis and had these discussions with my clients for many, many years. So it could apply to any business, but there will be a few unique items for the cannabis industry. But getting your books in order now will save you time and money on your tax prep fees, but also allows for tax and profitability planning before the year is over. You have a lot of options before the year is open that you don't after the year. A specific example of that is, say you need a new truck for your cultivation facility. If you're looking at your books and you're seeing a tax bill coming down the line with your accountant, then maybe buying that truck before year end can help your tax situation through Section 179 and depreciation on that vehicle or other piece of equipment. At the end of each slide, I'm going to ask Peter to chime in. He always has some great insight that I appreciate.
So, I mean, my insight here would be, you know, make the most out of the money that you're spending on your tax prep by having an active conversation with your accountant now instead of waiting till tax season begins in early next year. And what you're really going to do here is set yourself up for success by having those conversations early. Like Jim just mentioned, one example of the truck. I mean, another example that you could look at would be employee bonuses. That's something that you'd want to establish before year end. So just set yourself up for success, have the conversations now, get your books in order, and that'll give you your best chance to reduce your liabilities and make some calculated decisions.
So yes, think of closing your books in September as a dress rehearsal for December. I'm a big fan and believer that the books of any small business, and to this day, the cannabis industry really is small business. There's some large multi-state operators, but for the most part, these are small businesses. But no matter what size your business, large or small, your book should be closed out each month, and you should get a financial statement as the owner of a cannabis business. You should get a financial statement by, say, the third week of the month following month end. So by the third week of October, I will get the books for September of 2020 and for the 9 months ended September 30th. Every business owner should get that. If you don't, you're really flying blind. You want to tie out your balance sheet and income statement, as I said, by the middle to the third week of the following month. And the cannabis industry, in a lot of ways, is not as organized as other industries. What I mean by that is here we sit in October and we are still working on tying out 2019 books to get tax returns due that are due on October 15th, which is a week from tomorrow, as everybody here at Bridge West knows, because we're all working hard to finish 2019. But you shouldn't be working on your 2019 books in October of 2020. You should be working on those with your accountant in the first few weeks or 2 months of the new year. So as 2020 comes to an end, try to get your books to your accountant in January or February. They will really appreciate it, and they may be able to get your tax returns done without going on extension. Peter.
I really love the dress rehearsal analogy here, Jim, because you wouldn't leave for an important meeting or an important event without taking a look in the mirror, making sure that you look the way that you want. And I think that analogy really applies greatly here. Kind of like we said on the last slide, if you wait till January to take a hard look at this, you're just doing yourself a disservice and you're not going to have the opportunities that you would have today. So do that dress rehearsal and take a look at what you've done this year, and let's see what we can improve.
Right. And what we mean by dress rehearsal is get your books tied out through September and then sit down with your CFO, your controller, your outside CPA, and take a look at things. And now we'll do a little bit deeper dive into what we mean by tying things out monthly anyway. Let's go. There we are. So let's start by talking about the balance sheet. A lot of this is accounting 101, but it's so important to emphasize the basics. And really this webinar is about making sure you've got the basics covered. Number one, reconcile that bank statement. Look at that bank statement and see what you have. Does the balance on your bank statement match your balance sheet checking account balances? If you happen to have cash in the safe, do a count at the end of the month and make sure that the cash in the safe on the balance sheet is the same as the cash count of the safe. On the bank reconciliation, if your bank statement looks different from your books, maybe it's outstanding checks, maybe it's deposits in transit, but do a nice bank reconciliation and get those cash accounts tied out. Actually, here at Bridge West, we don't necessarily look at the cash accounts all that closely for a tax return. For an audited financial statement, yes, but we really do depend on our clients to get their cash balances right, their checking account or their cash in the safe. But now comes a subject, sort of the next item as you go down the balance sheet is inventory. And inventory can be a very tricky thing for the cannabis business, and it's very important. And we'll touch on IRS Code Section 280E from time to time, but 280E allows for cost of goods sold. It allows you to reduce your income by your cost of goods sold. And cost of goods sold starts out with inventoriable costs. So the costs go into inventory, and then they drop down into cost of goods sold when the product is sold. So purchased inventory is fairly simple. That is simply what you paid for it. If you're buying your pounds, if you don't have a cultivation and you're buying your pounds and you're buying your infused products on the marketplace, then you'll carry those at your cost to bring those in. And that would also include transportation goes into an inventoriable cost. Self-grown inventory is a lot trickier. It's a little harder to cost out. And the question I ask our clients all the time, do you know what it costs you to grow a pound? Sometimes when we actually dive into it and look at the true costs, including their direct costs, which is rent on the cultivation facility, labor, nutrients, utilities, and then potentially some allocated overhead like officer's salary, if the officers are spending time in the cultivation. Licensing for the cultivation can be allocated to inventory and then cost of goods sold. So you get all your costs in, and then you divide that by the pounds produced. And there's the equation at the bottom in red. If you don't know what your cost per pound to grow is, you could be in trouble, because if you don't know your cost per pound to grow, then you don't know how to price your product. And you want to have a good margin in this industry to survive. You know, the old buy it for $1 or grow it for $1 and sell it for $2 doesn't necessarily work in the cannabis industry, because all your costs outside of cost of goods sold are not deductible. So you have to have, you pay tax on your gross profit. So you have to have enough gross profit to pay your taxes, pay your overhead, and hopefully still have some money left over for your owners. One little joke I like, and it's not that funny actually, but it goes, if you don't know what your costs are, you will pretty soon. Because when you're paying your bills and you're wondering why you don't have any money at the end of the month, it could be because you're not understanding your true costs. And then in Colorado, we use the metric system, and metric is very, very good at inventory weight. It doesn't really track cost, it tracks weight in number of units. So you want to tie your physical inventory back to your metric system reports at the end of each month. And Peter, you're, I think, a little bit familiar with metric, aren't you?
Yeah, so we use metric here in Louisiana as well. And I would kind of echo your comment there, which is, you know, a lot of, especially new operators, don't over rely on metric and think that you're going to have your costs, your cost data, everything that you need. Because with metric, you're really just going to have weight at different stages of production. Now, it's valuable data. It's important for the state for tracking purposes, but you got to take that a step further and really capture and allocate your cost appropriately throughout your facility, especially if you're doing cultivation and manufacturing, because then it just becomes even more complicated. And while we're on the topic of the balance sheet, I think, you know, another opportunity here, especially at year end, and with 2020 being the crazy year that it was with the pandemic, you really want to look at your accounts receivable and look at opportunities for bad debt as well. So that would be my two comments on the balance sheet. Jim, echoing your comment, know your costs, don't over rely on metric, because you're only going to have production data there. So you really need to take that a step further and have a system in place, and then look for other opportunities in those balance sheet accounts, particularly this year, just considering how cash strapped many companies are. Let's look at that AR and see if there's anything we can write off.
That's a very good point. And yeah, when people sell their product, producers and cultivators sell their product, they tend to charge more if you can't pay them right away. So just as a management profitability, try not to finance your inventory. Try to pay cash for it if you can. You'll get much better pricing in the market. The last comment I want to make on this slide is that when you actually analyze it, some producers might find out that their cultivation is not that efficient. When they factor in all their costs and divide it by their yield, their cost per pound could end up being more than they could buy it for in the open market. And I've had that conversation many times, that people aren't being efficient in their grows, or maybe that they've had crop failures, so the pounds produced is way down. So really understand that cost per pound and figure out if it really is worth it to keep your cultivation, or would you be better off not having a cultivation and just buying and selling? That's it for this slide, I believe. Property and equipment, we touched on that earlier. I'll do a little bit of a deeper dive here. You know, making sure your large purchases have been recorded. So generally supplies and repairs and maintenance are going to be expensed on the income statement. But if you are spending money on your equipment, that significantly increases the life of that piece of property. and it's more than a few $100s, then you might want to capitalize that and put it on your balance sheet as part of your equipment. So in this dress rehearsal, we want to estimate the last bullet point here, and then I'm going to let Peter talk about dispositions, but estimate your annual depreciation expense. Depreciation expense is an estimate anyway. You're just estimating how that asset is being used up over its estimated useful life. So make sure when you're doing that dress rehearsal with your accountant that you're estimating depreciation expense. And again, it's a great place for tax planning where you can say, oh, maybe we should buy something. We really needed to replace these light fixtures anyway. Let's do it before the end of the year so we can take depreciation. Back to Mr. 280E is your depreciation in the cultivation and extraction side of the business is deductible as part of your adjustment to income under cost of goods sold, while depreciation for your retail space is not going to be deductible. So keep that in mind when you're doing tax planning. You want to keep your cost of retail as low as possible because those expenses are not going to be deductible. But another place people overlook is dispositions. Peter?
Yeah, and so in my experience, something I've noticed, especially in the cannabis industry, is that companies tend to be very calculated about their capital outlays and their equipment purchases, but they're not quite as calculated when it comes to disposing of assets. And another factor here is that as a new high growth industry, we see technology changing and turning over every couple of years. So, what's popular this year or what's new this year might not be the same in subsequent years. So you really want to take the time during your tax planning phase and during we'll continue with the dress rehearsal analogy to look at opportunities in that regard with regard to disposing of assets and to have a calculated approach there and to know the real effect of it before you make the decision. And so what we'd recommend is going through that list now, looking at your equipment and your property and deciding, is there an opportunity there and is now the time or should we wait till next year?
Yes, very good point. The other couple of points I want to make on dispositions is many states, including Colorado, have a personal property tax for businesses. So you don't want to have any equipment on your books that's going to get taxed if you're no longer using it. And from the IRS's point of view, it's not enough just to take the piece of equipment and put it over in some corner where it collects dust. You want to actually dispose of it, get it off site, take it to the junkyard if it's no longer in use, or sell it for scrap. But really clean up your depreciation schedule and make sure there's no equipment on there that is not in service, is the correct phrase I'm looking for. So other assets, analyze these for possible write-offs. An example of that would be, maybe on your balance sheet, you've got your original cost of getting your licenses. And those licenses need to be renewed every year or every 2 years. So you might want to look and make sure you've written off all your old licenses that have expired and those aren't sitting on your balance sheet anymore. License fees for cultivation and extraction are going to be deductible under 280E, but licenses for retail are not. Just the same, write them off, get them off your balance sheet, make sure that you're carrying your other assets at the correct amounts and writing off anything that is no longer an asset. Peter, I don't think there's much else on this slide, is there?
No, I think you've covered it pretty well.
All right, well, that takes us through the asset side of the balance sheet. Now we're going to move on to the liabilities. So on the liabilities side, this industry does not get bank loans. There might be some sale leasebacks, there might be some private equity or private loans, but as a general rule, the banks are not lending to this industry or letting mortgages out on this industry. So you're going to have a lot of notes and loans from your friends and family. We see that a lot. These companies, these cannabis companies, initial capitalization and startup money comes from friends and family. So make sure those loans are documented, the first bullet point there. If you have borrowed money from a relative or a friend, distill it down to a note. Sign that note and make sure that the lender and the borrower both have copies. That way, if something happens to somebody, incapacitated or they pass away, you know, the family can say, hey, we have this note here, you owe us $100,000. If that loan is not properly documented, the family is going to have a much harder time collecting that loan. And record interest expense on your loans. As a general rule, you have to record some interest on any loan. The IRS does not believe in no interest loans. So build in an interest factor on that and make sure you're recording the interest properly in your income statement with principal reducing the liability up on the balance sheet. I'll come back to that in just a second with Peter. While I touched briefly on sales and payroll tax liabilities, should equal the next month's payments. So the money you take out of your employees' paychecks, that should tie out to the payroll reports, and you'll pay that liability in the month after month end, the month subsequent. So make sure that the liability on your books is equal to the payment you make in the subsequent month. I know this is accounting 101 for everybody, but trust me, we really struggle with these issues in our clients, and we get books from our clients that the liabilities do not tie up to the next month. Sometimes we see payroll accounts with debit balances and when they clearly should have a credit balance. I warned you at the beginning that we were going to get very technical on this and very accounting oriented, so I hope the audience appreciates when we start to talk about debits and credits. Over to sales tax. The sales tax, you are just a custodian for your state and local government. So when you charge sales tax, which in Colorado and Denver is 21% of each sale, you're just holding that money on behalf of the state and local government, and you'll turn that over once again in the month subsequent to the month you collected it. And those numbers should tie back to your point of sale system, your cash register system at the retail location. Now, cultivators, they're subject to an excise tax, and so that would show up as a liability on the books of a cultivator. Peter.
And what I would underscore here is that this is really a great opportunity before year end to make sure that you have all these supporting documents. And by that, I mean the loan documents, the interest payments, the 941s, sales tax. So as you're going through and tying everything out, it's a great chance to make sure that throughout the year, you've kept track of everything appropriately and that you actually have all these source documents. And it really will make our job a lot easier when we come in to do the taxes. And in the long run, it'll save you money because we're not sitting there trying to track these things down.
Yes, especially if you're in a state that requires audited financial statements. Basically, if Bridge West is your auditor, we, by definition, cannot be preparing the books because we'd be auditing our own work. So if you're in a state that requires audited financial statements, and I'm trying to think of some of those, who those states are, Hawaii, there's a good one. You need to have enough internal horsepower in your accounting department to produce these financial statements with correct balances that can be audited. The other piece of that is you don't want to be paying somebody CPA rates. You know, our fees are very market oriented, but our fees are definitely more than you would pay an in-house bookkeeper to keep your books in good order. So think about that too, is, you know, don't be handing your books to your CPA firm with everything out of balance. The example I used, if your payroll liabilities are showing debit balances, maybe you should look at that before you give it to your CPA firm. And now the last piece of the balance sheet is equity. And boy, do we struggle here with some of our tax clients. The balances should be equal to the prior year tax returns. Easier said than done. For the balances to tie to the prior year tax returns, you need to follow that last bullet point that all your prior year adjusting journal entries have been correctly posted. So that's the first thing we look at in a partnership, is each partner's capital account should tie back to the prior year's tax return, where it will appear, each partner's capital account appears on a Form K-1 on a partnership tax return. And partnership taxation is, in my opinion, more complicated than if you're a regular old C corporation. If you're a partnership, those partnership capital accounts change every year as you recognize income, make distributions, maybe there's capital calls. So those partners' capital accounts are constantly changing, as opposed to a corporation where once you fund the capital stock, it pretty much just sits at that number for the life of the corporation. Now, there are other numbers that do change within a corporation as it recognizes its after-tax income, and that changes retained earnings. But look at those capital accounts, whether you're a corporation or a partnership, which are the two general forms that we see in cannabis companies, form of entity. You know, have a capital table for your partnership or your corporation. Who owns what? Has it changed? Have you promised people equity? Have you issued additional shares of stock? Have you considered a second class of stock for a money raise? All that is captured in what we call a cap table or a capitalization table, basically showing a small Excel spreadsheet with a column for each partner and rows that explain the money that's come in and the money that's come out over the years. That's a cap table, and those are very important. If there's ever a dispute or a falling out or a partner wants to leave for some reason, the first thing you're going to be looking at is the capitalization table, or your lawyer will be looking at the capitalization table to see who owns what part of this company and does it match up with your corporate documents. Peter.
I think one thing to pay particular attention to here, especially in the cannabis industry, because we see one operator will often have multiple entities, and usually there's going to be potentially a corporation, partnership, and several different entities involved. And I think the equity situation can become murky whenever you have different shareholders and different entities, or you have deals going back and forth between the two entities. So kind of as Jim was pointing out, definitely super important for the partnerships, a little less complicated on the corporation side, but the multiple entities can sometimes make this more complicated than you would imagine. And so get ahead of it and have all that documentation in order.
Yes. So if you change your capital structure, you bring in a new partner, a partner leaves, or you change your ownership, document that in minutes to a meeting where you decided, and then either do it yourself or have your attorney preferably update your partnership or corporate operating agreement. You don't have to redo your whole partnership agreement. It can just be a one-page addendum. But documentation is critical when it comes to equity, because that's the true ownership of this cannabis business. And the cannabis business can be very valuable. So spend the time, spend the money on your lawyer to document the equity section of your balance sheet carefully and correctly. Moving on to the income statement, and in about 15 minutes, we're going to turn it over to Calvin Shannon, who is going to give us an update on 471C. So we have a few minutes here. We'll go through the income statement, and then we'll take a few questions, and then we'll bring Calvin up to bat here. All right. So what I like to do on all companies, but especially cannabis companies, is tie the sales to the sales tax returns. That has been an absolute godsend under state, local, or IRS audits. You know, what state and locals and the IRS look for on sales is unreported sales. We all know the story of maybe a guy kept a bar where, you know, $1 went in the till to be taxed and the other one went in his pocket, underreporting his income. You really can't do that in the cannabis industry, because in addition to having to pay taxes, interest, and penalties if you're caught, you could lose your license. And most cannabis business owners are very conscientious about reporting their sales. We have really good software out there for point of sale systems. Greenbits is one I can think of. Peter, what names come to mind on POS for sales?
Leaf Logic is one that we work with a
yeah.
lot. Very, very common. I like that one a lot. And there's just so many of them out there. A lot of them are really good.
Very good, and they produce very good reports. So tie your year-to-date sales per your POS system to the sales tax returns. What we like to do for the sales part of a tax return is add up the 12 months of sales tax returns, put that down on the tax return as the sales reported on the tax return, and if there's an IRS audit, you get through that unreported income part of the audit very, very quickly when they see that you've tied out sales to your POS system. Similarly, now we're moving on to expenses. wages should tie to the payroll tax reports, sales tax to the sales tax reports. So the 941 is where you report your withholding on the federal level. On the state level, that has a separate report for the money you take out of people's paychecks. And so your W-2s should add up to what's on the income statement correctly. And another thing about the cannabis industry that we like to do, and this applies maybe more to small business than a large multi-state operator where it may not be practical, but you know, your cultivation labor is deductible while your retail labor is not. So, and sometimes you have employees that are working in both the dispensary and a cultivation for a vertically integrated company. So we have the client write down on each W-2 or in an Excel spreadsheet what that employee does. And keep in mind for 280E, it doesn't matter how much the employee is paid. The IRS doesn't care about that. The IRS cares about what the employee does. So if they're working in the cultivation, that's deductible. If they're behind the counter bud tending, that's not deductible. Now, if they're spending time in the back room packaging and rolling joints, that labor is deductible. So a lot of complications to payroll. Very important that you keep very careful track of what your employees are doing. We talked a little bit about interest expense. You want to make sure that ties back to your notes payable. Depreciation, as we said, is an estimate, but it's just the same. You want to look and make sure that is correct and ties to your depreciation schedule. And do the other balances look reasonable? That's some of the things I do in my consulting and with our clients here at Bridge West is, hey, I just had a case in the last week or so. The client actually might be on this phone call, so I certainly will not mention their name, but looked at their balance sheet and their inventory is 3 times what it was the year before. So how did that happen? You know, that was based on numbers that were given to us. So I had the client go back and check and said, hey, did you really have 200-300 pounds of cannabis on hand at the last day of 2019? And when they went back and looked, they said, no, there's no way we had 300 pounds on hand. So do things look reasonable? That's the first indicator. That can also help a business owner detect if there's fraud or theft going on. You know, hey, we have all these sales, our sales are really good. Why is there no cash? So look at your accounts for reasonableness too. If you go up and down the income statement, do things look okay? Are they out of whack? You know, with the pandemic, COVID-19, nobody's been traveling. If you have a whole bunch of travel on your income statement, the business owner might want to look into that and say, what's going on here? Why do we have travel when all our big events have moved to virtual seminars? I think that's what I have on this slide, Peter.
Yeah, I'd say, Jim, in addition to looking when you're doing that reasonableness test, let's also look and try to identify some trends. This will help you with your planning, but it could also be an indication of fraud or theft. And at that time, you can also kind of take a look at your internal controls and your processes over your income reporting, just to make sure that everything is reasonable and that it lines up with what you expect. I mean, we are in a high growth industry, but things are still predictable, and you should be able to identify trends compared to prior years and projections and kind of see how things ironed out and see if you met your own expectations internally.
That's an excellent point, Peter. And if you're getting monthly financial statements, then you can put those side by side, one column for each month, and really go through and look at those trends. Are your sales going up or down? Are your costs going up and down? Is your profit margin declining or increasing? So if you're getting monthly financial statements, you can also print out a side-by-side monthly comparison. And we do that every month at Bridge West. You know, as accountants, it's kind of second nature to us, but we do like to see that side-by-side spreadsheet of each month's income statement. All right, well, as we've been talking, 280E is still with us. Maybe it'll go away someday, but as I was quoted recently in the press, the IRS believes in 280E. They do expect cannabis companies to comply with 280E. And for our clients, we do that. You know, we don't take on clients who want us to ignore 280E. It's just wrong in this point in time to ignore 280E. So what you want to do is learn how to live with it. Can gross profit be improved? Like I said, you need enough gross profit to pay your tax on gross profit, plus pay your SG&A, selling general administrative expenses, and hopefully still have something left over at the bottom line. So really look at that. Like I said, I like to see gross profit margins in above 50%. It's counterintuitive. People think, well, if I'm going to be taxed on my gross profit, I want to really load up my cost of goods sold and make my gross profit as small as possible. And while that technique can lower your taxes, you really need good margins. Our most profitable clients have up to 60 and 70% gross profit. And that's when you're growing it for $1, selling it for $3. Some states where I'm working, like Massachusetts, it far exceeds that because there's such a shortage that the cultivators in Massachusetts, they're getting about $4,000 a pound at wholesale. And if they're growing it for $1,000 a pound, including their excise taxes, they're getting a 4-fer, not a 3-fer. So really look at that gross profit, consult with your CPA, your CFO, feel free to call us here at Bridge West, and let's do a deep dive into your cost accounting and see if we can improve your gross profit. Along those lines, you got to be super lean in this industry. Your expenses should only be for growing, extracting, and selling cannabis. If those expenses don't relate to that, they should not be there. So no Maseratis on the books, no vacations to Las Vegas, no friends and family who doesn't actually work there. As one of my good CPA friends up in Seattle said to a client one time, he said, you don't have a 280E problem, you have a spending problem. So keep those books lean and mean and only have expenses that are absolutely necessary. And as you scour through those with your CPA or your CFO, be asking yourself, what expenses can be reduced or eliminated? Peter?
Yeah, additionally, Jim, something else I'd point out, you don't want to get blinded by 280E. You got to focus on the fundamentals of the business. This is such a big issue for the industry, and it's been being debated and contested for over a decade now. We still have to live with it, but you can't let that control how you operate the business from a fundamental standpoint, and you really have to focus on that gross profit. Well, you only have two mechanisms when it comes to the gross profit. You either raise your prices or you lower your cost. And I think in this market that we're observing today, particularly with the natural disasters and the wildfires, the cost of cannabis to the consumer does seem to be increasing. So as you're doing your tax planning and your 280E planning, in addition to looking at reducing and eliminating expenses, look at your cost. Is it worth potentially launching a premium line where you charge more? We're seeing that be very successful in a lot of states, particularly in California. I mean, and there's some stores in Southern California where eighths are going for $60 to $80, and that's in California, one of the largest producers in the country. So don't short sell yourself, but also focus on the fundamentals of the business and that gross profit.
Yeah, and we have clients who do the opposite and are very successful selling, $100 ounces, and they're able to grow cheap enough that they can make a profit on $100 ounces. It's a good point in this program to say you can be very profitable in the cannabis industry, even with 280E and not being able to deduct your expenses. So we have clients who do very, very well on an after-tax basis. We also have clients that when we analyze their books, they find themselves in excess of 100% tax bracket. So it's all over the board, but make sure that or work hard to make sure you're in the group of people who are actually making money on an after-tax basis. Did you have anything else on this slide, Peter?
No.
Okay. Do we have Calvin?
Yep, I'm here. How you doing, Jim?
Very good. Before we queue you up, let me this might be a good place to see if we have any questions. Lisa, do we have any questions?
I don't see any in the chat yet, Jim.
If anybody has any questions, please type them into the chat area. And then let me introduce Calvin. Shannon. Like I said, Calvin's a principal with our parent company, Beckerman, Grassroom, Mayer. Although pretty much 100% of his work is with Bridge West, and we are a subsidiary of that company. So we have a very deep bench. They've got some great tax people up there that help us out with some very complex tax situations we see for a lot of our, or not a lot, but some of our clients. And Calvin, along with a very well-known cannabis attorney, Nick Richards, have been working on IRS Code Section 471C, as I alluded to at the very beginning. 471C is very new. It is came in with the first Trump tax bill at the end of 2018, or was it 17? I guess it came in 17, effective for tax years of 18 and 19. And the big takeaway that I take away from 471C, it's very important how a company keeps its books. If you want to be part of 271C and try to take advantage of it, you need a very strong accounting department, and those books should come to us 471C compliant. So that's my lead in. I'm going to let Calvin take it from there.
Yeah, thank you, Jim. You can still hear me well? You can still hear me well?
Yes.
Okay, good. So yeah, as Jim mentioned, I'm gonna give a quick recap of where we are in regards to Code Section 471C and what it means for Schedule 1 traffickers subject to 280E. I'll start clear back at the beginning, which really started this spring, and then run clear up to what we know as of today, with maybe more time spent towards the later piece here. But as Jim mentioned, effective January 1st, 2018, the Internal Revenue Code was changed, adding Section 471C. And 471C, just really quickly, gave certain qualifying taxpayers the latitude to account for inventory in a couple different ways. One of the, and what's important for the purpose of this conversation, is it basically allowed them to account for inventory for tax purposes in a way that's consistent with their underlying books and records. And I know when this first came out, there was some initial conversation. Wow, it seems like the tax codes would possibly allow someone subject to 280 to characterize costs that would otherwise be expenses. And of course, there are no deductible expenses for trafficking companies. It would be able to characterize all these expenditures as inventoriable costs and then flush them through cost of goods sold, basically bypassing 280E. And when that discussions were first happening early in 2018, all the way, for the first year and a half, 2 years, I was thinking, that's just too aggressive. It doesn't work. Then really what the biggest next step that happened was in March of 2020, there was a watchdog group at the U.S. Treasury called the Taxpayer Inspector General. They issued a long report to the IRS. Like I said, they're another agency at the Treasury that's responsible for oversight of the IRS. They issued this report to the IRS. It's a long report. About 80% of it is IRS. You need to start working harder on the cannabis industry, doing more audits. There's a lot of non-compliance out there. Then maybe 20% of it was, oh yeah, by the way, IRS, this new code section 471C seems to be a reasonable position for taxpayers to take to help mitigate 280E. IRS, you should communicate. You should figure this out, tell everyone your thoughts, and communicate this to taxpayers. In that same report, the IRS was given an opportunity to respond to the Taxpayer Inspector General's comments, and it was funny. they responded, yes, we're going to figure out how to do a good job of auditing cannabis companies, and we're going to get on this. And then they said, regarding the 471C issue, we don't have time. We're not going to deal with it right now. So that report came out. I read it, and the team here at Bridgewest talked quite a bit about it. We talked, as Jim said, with one of the more well-known 280 attorneys out of Colorado, as a former IRS agent, and we decided, you know what, this is, well, we certainly can't say absolutely that this would work. And when I say work, I mean, be all right with the IRS, and then whether or not it is all right with the IRS would be, if it went to court, the courts would agree with the taxpayer position to characterize more cost as inventoriable. But it seems reasonable enough to at least talk to our clients, say it's a position that they could potentially take, discuss in great detail what the drawbacks are, being that it could be reversed and you could potentially owe penalties and interest on unpaid tax amounts, but also the advantages that, to the extent it works, then you could, it certainly could help your position in mitigating 280E. So I actually had co-written an article with Nick this spring, and we've done some webinars, and I would actually, I believe both that webinar and articles are in the Bridgewest website. So any listener that would want to spend more time learning and understanding about 471C, that's certainly a good place to start. Fast forward through the summer, and a couple additional things have happened. The IRS issued some proposed regulations where they address 471C. They don't specifically reference the cannabis industry in these proposed regulations, nor do they reference 280E, but they did make some comments, among other things, but some comments in these proposed regs that you can't use 471C to recharacterize an expenditure that would otherwise be non-deductible, to recharacterize that as inventory to get it through cost of goods sold and deductible. A couple things to mention about that is, one thing, they're just proposed regs, they're not final regs from the IRS, and then secondarily, regulations are the IRS's interpretation or opinion on interpreting what the law is. It's not the law. The law is what Congress writes through and issues through the Internal Revenue Code. So, all along we knew that the IRS would probably not necessarily agree with this position, and as I mentioned earlier, it would potentially be something that will need to be settled out in the courts. So then we got those regs, and that's kind of where we are with any communication from the IRS. Obviously, I have not heard of any taxpayer who has filed using 471C, taking the position at 471C to aggressively characterize expenditures as inventoriable cost. I think it's just far too early to hear about the IRS auditing that and what the results were, or what it looked like, what it will look like when it goes to court. So we're just kind of in a waiting game right now. Yeah, I think that's pretty much what brings us up to date. Well, I guess the one additional maybe comment that I would make is, on September 12th, and the IRS had issued through their website some frequently asked questions and answers, were kind of addressing taxes in the cannabis industry, and they did touch on the 280E and what it meant for accounting for inventory to get to get to your cost of goods sold, and that's deductible. They reference code section 471, which is, they're absolutely right. Code section 471 is certainly the code section that would inform how a taxpayer should account for inventory and calculate cost of goods sold. But that's all they said. You should reference 471 in accounting for inventory, and all the information that they gave regarding the calculation of cost of goods sold, as well as everything else for the cannabis industry, was certainly nothing new that hadn't been communicated by the IRS for quite a while. As a matter of fact, their discussion on calculating cost of goods sold, they actually referenced their chief counsel memo that came out in 2015. So there was really nothing new from that most recent release on September 12th. I had actually written a blog, which should be on our website as well, discussing that release. So I think that's pretty much all I have for an update. I don't know, Jim, Peter, would you guys have anything additional to contribute?
No, that was a great update. And like I said, my takeaway is that we cannot do the adjusting journal entries and start moving things around your income statement and balance sheet and expect the IRS to honor 471C. You've got to give your books to us in a manner the way you choose to keep your books. So if you choose to put some things up into cost of goods sold or inventory and then cost of goods sold, that has to be the way the books come to us. So
Yep.
it's real good, Helen.
Yeah, so that's a great point, Jim. And honestly, I would say that's the case whether or not you intend on using 471C to account for inventory. Either way, you're probably going to want to allocate some cost up into inventoriable costs in the 471C. And the best argument that you could possibly have under IRS audit under either scenario is this is the way it's really reflected in our underlying books and records, and it's consistent with our accounting policies. Obviously, it's more critical if you're going to be more aggressive and say you're using 471C, but even if you have a grow and you say, you know what, we don't want to do that, we're just going to account strictly based on the regs under 471 that's actually referenced by the 2015 IRS Chief Counsel Memorandum, you're still better off for your underlying books and records to really reflect you accounting for your cost of goods sold in that way.
Yes. So we have just a few minutes left. We might run over a few minutes to try to get through some of these questions. We got some good questions here, starting with Sam. Would a bad debt expense be deductible if it's directly related to, I can't quite read the rest of that. I would say no. Bad debts are not going to be deductible under 280E because they're not a direct cost of production or purchasing your account. So the answer there is, the cannabis industry is not a great industry to be extending credit. So if you're selling as a producer, cultivator, don't extend credit to your customers because most likely your bad debt will not be deductible. And then we have another question here from Randy. And I might have misspoken. This is a good question to pin me down here, Randy. Can Section 179 and bonus depreciation be claimed for a cannabis company? I might have misspoken earlier. We're talking about Section 179. Our experience under audit, IRS audits, we've been through probably about 40 IRS audits over the last 10 years, and I've testified in tax court on 280E as well. But yes, the IRS is looking for cannabis companies to be using double declining balance, which is basically makers. So no Section 179 and no bonus depreciation is the position of the IRS at this time.
Yeah, I can add a couple more comments. Basically, where that's from is the regs that, as I mentioned before, are specifically referenced in the IRS Chief Counsel Memorandum, the regs for Code Section 471C, where it says that there is a bucket of indirect production cost that can be inventoried and then ultimately included into cost of goods sold. And that bucket would include depreciation from equipment. But it expressly says to the extent that that's how you're accounting for depreciation on your underlying books and records, and the depreciation is consistent with GAAP. So obviously, once full deduction 179 or bonus depreciation would not be consistent with GAAP, and that's why you're really pretty much stuck with some sort of GAAP consistent depreciation.
Yeah, we have a question here from Raj. Does a for-profit company receive a write-off for donating to a non-profit cannabis company? I would say the answer to that is no, because a donation is not a direct cost of production, and pretty much you're limited to direct cost of production or expenses you classify under 471C as inventoriable costs. So, Peter, you've done some work with some nonprofits down south there. What's your opinion on a for-profit cannabis companies donating to a not-for-profit cannabis company?
I mean, depending upon the nature of the donation, I'd say it's going to be fairly difficult to have that qualify as cost of goods sold. So I would agree with your commentary there, Jim.
Okay, let's see if we have any more. I think that's it for questions. Anybody else out there? If I get a question zapped into us, we'll try to answer it, but I see we're coming right up on 1 o'clock Mountain Time, and we had budgeted an hour for this webinar. So I hope all the attendees enjoyed it. Calvin and I and Peter, as you can probably tell by now, we could talk about these subjects all day long, but it's a busy time of year for all of us. And so with that, I think we'll say goodbye. Calvin and Peter, you want to say goodbye?
Thanks for having me today, Jim. That was very informative, and I appreciate it.
Yep, it was great to have the opportunity to talk with you guys and all our listeners. I hope you guys all enjoy the rest of your afternoon.
Thank you all very much, and goodbye.